Hey guys, Doug the retirement guy here. We got a new one here, and I really got to say this. One of our Patreon supporters contacted me and asked, "Hey, I'm just going into retirement. I called my Fidelity account manager, and he basically told me, you know, different funds to be into, and bonds came up. And this is actually the best bond fund that a Fidelity manager could come up with, and it's under the Spider family, which is State Street Global Advisors. He sent it to me and said, "Could you review this and give me an update, what your thoughts are to it, so I can compare the two?" And I said, "No problem. Someone who wants to support the channel, I'd be more than happy to do that for them." So before we get into it, I want to say, hey, thanks to everyone out there who does support the channel with the Patreon, and everyone who does support it with the sponsorship, thumbs up, and so on. Guys, I really appreciate it. The channel is growing. We do this for you, and we do it for is give you the information you need to grow. So let's get into this. Should we invest into the Spider High Yield Bond ETF, paying a 7.54 dividend? So first off, getting into this program, the Spider Profile High Yield Bond, I can see where a lot of financial advisors are pushing people with the threat that the interest rates were going to drop when the Trump administration came into place, and people are thinking the interest rate's going to go down, bond rates are going to go up. Let's make the switch. So we kind of look into this one here. It is a monthly paying bond fund, which is good. Distribution rate 7.78. Expense rate here is 0.05, dirt cheap. So I'm impressed with this one. And a 7.54% 30-day yield is what I expected in a bond fund because they have that money coming in on a regular basis. It's like having a interest payment coming every month, so you can count on that. But these guys do a lot of work with keeping that they get the highest possible yields with the right terms and keeping the cost down. So right now I'm happy with Fidelity giving them a Spider, but why Fidelity doesn't do this is beyond me. Let's take a look at the holdings. And we look at this as they do have some U.S. government money in the money market, but you can see a lot of the companies that they're dealing with. American Airlines, DirecTV, QuickRite. There's a lot of companies that they're putting money into and doing some different bonds with. And I went deeper into this to find out the fund maturity ladder. And you will see most of their bonds are in that 3 to 5 year period. So the second rank is going to be 5 to 7, and then third is 2 to 3. So it's really that they're locking this stuff up between that 2 to 7 year magic period to get the most out of the funds. So to me, in a bond market, this is really right where you want to be. So they're managing this properly. So why SPHY? Well, first off, it's at 7.8% yield to maturity. And that's definitely a huge number when you're looking at bonds. I think the other thing that we need to talk about too is why would you be into this fund? Is because you want income and you want high security income over a longer period of time. And that's what bonds are going to give you. They're not going to give you the double digits return, but they're going to give you the safe and secure security that you're looking for. That's why when you look at the 7.75% 30-day yield, they have money coming in because they have interest payments coming in on a regular basis. So it's a very safe and secure spot to put money. They do offer a monthly dividend, which is very, very nice. So that you're getting money each and every month. Here on the channel, like we've always said, we like the regular cash flow from monthly dividend incomes so that you can pay your bills and go off and live your day and not have to worry about things. The other nice thing about this, the fund has been out there since June of 2012. So we're almost 13 full years into this, and it's a great fund for them to be in. Let's take a look at the SPHY's returns. And we have it set up with their actual NAV and then also market value. So year to date so far, this is basically just updated for March. So they're at 2.23 for market value. 1 year, they've showed a 10.32% return. 3-year 5.7, 5-year 5.07, and 10-year 4.56. So kind of a balance. They've had 1 year that I would call it's outrageously high, but then we have 2 year, the two markets, the 3 and the 5, that are right what we expect. And here's the thing: when you're looking at these funds, if you can go 10 years out, there's so much that happens in 10 years in this world that if you got a positive at 10 years, it's almost a set it and forget it. Don't even worry about the situation, that you're going to get a nice return from it. But let's do this. We're going to put $10,000 into our calculator. It tells us where we're sitting. And in a year ago, in March of 24, we would have bought 426 shares with $10,000 invested. A year later, March of 25, we were only able to generate $132 worth of profit, or 1.32% return. Now we were able to get a dividend return of $773, or 7.73%. So that's right on track with it, but the growth of the stock is just very, very minimal. Now it gives a nice total of $905 for 9.05% total return, which is a nice number, but again, it's coming from that dividends, coming from that interest, not growth of the stock. When we look at the chart over time, I call it's really holding. And I mean, because we're looking at this and you see so many rocky mountains into it, but when we draw a flat line to us, 23.57 is the average price. And when you look at the chart, you're pretty much there 80% of the time. The current rate of 23.51, you're only 0.06% below the average. So this thing is just holding pretty much just a straight, level, narrow line with you'll have a few minor jumps to it or bumps to it, but nothing spectacular. It's going to make you wake up at night and wonder where's your money going. So in summary, 12 months return of 1.32%. I'm going to give you a thumbs up because every time you get any kind of a positive return is good. A dividend return of 7.73% over 12 months. I'll give that a thumbs up. And a total return of 9.05% over 12 months. Again, 3 thumbs up onto this one. So is this going to be good for a retirement account? And my answer is going to be yes. The dividend of 7.73 is a solid number to add to your retirement account. Would this be my only fund into it? Absolutely not. But this could be a cash flow or a cash situation that instead of having cash collecting a 4% return, which is what most cash is, you could take that cash, roll it into a dividend account, put it in this, and pick up 7.73. Plus add 1.32 for value. And bonds are very good. When interest rates go down, bonds are going to go up. And that's really where we're sitting. We're waiting for the interest rates to start dropping as everyone expected it to. It's just taking longer than overall time frame. So I put this one in as a moderate buy. And in each situation, and since we're doing this for one of our Patreon supporters, we're putting this into giving it him advice. Is, like I said, this is great if you want to park some cash. This is great if you want to add to a retirement account. But this is not where I would park majority of my money or any big parts of my money, because we've already shown you where we can put things into other retirement accounts that can generate 12, 13, 14% returns. And I'll put a couple of links down in the description if you like, that you can see some of our other videos where we show We have one fund that's creating 21% payout dividends. So again, for an overall fund, excellent. If you want to put cash reserves into this, excellent. If you want to just add on to your retirement account, great. But if you're looking for this to be your 100% total retirement fund, you're just going to need a ton of money to retire from this.